Ladies and gentlemen, today we're witnessing a financial move in Iraq that hasn't happened in years. The Central Bank of Iraq has officially cut the supply of dinars in circulation by exactly 3.8%. At first glance, that number might sound small, but in the world of monetary policy, it's huge. It's the kind of decision that can ripple through markets, impact exchange rates, and change how ordinary Iraqis live day to day. So, what does this cut in supply really mean? Think of it this way. Fewer dinars in circulation means each dinar theoretically holds more value. The central bank is essentially tightening the flow of money, trying to make the currency stronger and reduce the pressure from dollar demand. This is especially significant because Iraq has struggled for years with dollar dominance, black market trading, and inflation that hits ordinary households the hardest. But here's where it gets interesting. This is the first supply cut in years. For the longest time, Iraq has actually been pushing more currency into the system to meet government spending and cover rising costs. Now, the central bank is reversing that approach. Why? Analysts believe it's partly to control inflation, partly to stabilize the dinar against the US dollar, and partly to prepare for bigger reforms that could reshape Iraq's financial landscape. Imagine you're in Baghdad today. Exchange shops are buzzing, traders are recalculating their rates, and everyday people are asking, will this move finally make the dinar stronger? Or will it just make dollars even harder to find? Because when supply tightens, demand often shifts. If people believe the dinar is gaining strength, they may hold onto it longer. But if they believe dollars will get scarcer, they might rush to buy them, ironically fueling the very black market the central bank wants to calm. And let's not forget, a 3.8% cut may be just the beginning. Some economists suggest this could be the central bank testing the waters, seeing how the market reacts before taking bolder steps. Could this be the early sign of a future revaluation? Or is it simply a technical adjustment to stabilize inflation in the short term? That's the big question. When a central bank cuts the money supply, it's not just about numbers, it's about psychology, trust, and power. Iraq's central bank has reduced the flow of dinars by 3.8%. And the ripple effects could be enormous. Let's dive into the bigger picture. First, let's talk about why now. For years, Iraq has been awash in liquidity. Government spending, funded by oil revenues, kept pumping more dinars into the system. That worked when oil prices were high and stable. But the side effect was inflation, dollar shortages, and a widening gap between the official exchange rate and the black market. By cutting supply, the central bank is essentially stepping on the brakes, saying, enough is enough. It's time to defend the value of the dinar. But here's the thing. Iraq is not like other economies. In most countries, when money supply is tightened, people turn to local banks and trust the system. In Iraq, decades of instability have created a different reality. Many Iraqis trust cash more than banks, and the US dollar more than the dinar. So a tighter supply doesn't just mean fewer dinars floating around. It means more people may panic, hoard dollars, or turn to the black market. That's where the central bank's gamble comes in. Will this cut restore confidence or trigger fear? Next, the global factor. Iraq's economy is tied to oil and the US dollar. Every barrel of oil sold brings in dollars, not dinars. To convert those revenues into local spending, the central bank controls auctions where dollars are exchanged for dinars. If there are fewer dinars in circulation, those auctions become even more important. And if restrictions tighten too far, the US could step in, because Washington monitors how Iraqi dollars move, especially with concerns about smuggling, corruption, and sanctions evasion. This 3.8% cut might be small enough to avoid alarm, but it's a signal. Iraq wants to show it can manage its own currency without spiraling into chaos. Now let's turn to the markets. In Baghdad, Erbil, Basra, and Mosul, traders are already recalculating their numbers. Currency exchange shops thrive on small margins, and when supply shifts, those margins widen. A shopkeeper who bought dollars yesterday at one rate may find the market spiking today. That creates volatility, and volatility fuels speculation. Some Iraqis may see this cut as the first step toward a revaluation, holding on to dinars in hopes they'll be worth more later. Others may rush to dump them, fearing this is just the start of a shortage that makes life harder. Both reactions feed instability, and that's why the central bank must carefully manage its messaging. For the ordinary Iraqi household, the impact will be deeply personal. Imagine a mother in Najaf trying to buy groceries. If traders believe the dinar is strengthening, she might see prices for imported food stabilize or even fall slightly. But if traders believe dollars are getting harder to find, they'll raise prices to protect themselves. The same goes for medicine, electronics, and fuel, all heavily linked to the dollar. So while the central bank's move looks technical on paper, on the street it could mean the difference between hope and frustration. And here's another angle: government spending. With fewer dinars in circulation, the state's wage and subsidy payments become more strategic. Iraq is a country where millions of citizens depend on government salaries and pensions. If the dinar tightens, the government can claim those salaries are worth more. But if inflation persists, citizens will see it as just another squeeze. The political fallout could be intense, especially with parliamentary blocs eager to turn economic hardship into political gain. We also need to discuss the long game. Cutting supply by 3.8% may be just a test. Central banks rarely move in isolation. This could be a signal that Iraq is preparing for deeper monetary reforms, perhaps a gradual appreciation of the dinar, or even laying the groundwork for the long-rumored revaluation. Some analysts suggest the central bank is aligning itself with international standards, proving it can act independently and responsibly. If that's the case, today's 3.8% cut could be remembered as the first crack in the old system. But let's not get carried away. There are risks. If the cut goes too far, it could choke liquidity, making it harder for businesses to operate. Small companies that rely on cash flow could collapse, pushing more Iraqis into unemployment. Meanwhile, speculators in the black market could exploit shortages, driving rates higher and making life worse for average people. It's a delicate balance. Too much supply fuels inflation. Too little creates scarcity. The central bank must walk a tightrope. Ladies and gentlemen, here's the bottom line. A 3.8% cut in dinar supply is more than just a number. It's a test of Iraq's economic resilience. Will it stabilize the currency, build trust, and mark the start of reform? Or will it spark panic, feed the black market, and backfire? Only time will tell. But one thing is clear. For the first time in years, the central bank is not just reacting, it's acting. And that shift could define Iraq's financial future.